Every order you place in the stock market passes through Citadel. Not some orders. Every order. You think you're trading with an exchange, you're trading with a market maker who profits from the difference between what you want to pay and what you actually pay. The archives call this payment for order flow. You call it normal. In 1870, when John D. Rockefeller was buying railroads, he got the same intelligence advantage. He knew what competitors were bidding before he placed his own bid. One person saw every transaction. That person won. Today, one entity sees every trade in America. The difference is, Rockefeller had to build an empire to get that power. Citadel gets paid for it. This is the Gilded Archives, where the ledgers show you which pattern you're living inside. For 3 decades, payment for order flow has been treated as a technical efficiency, a necessary evil, a feature of modern markets. The records tell a different story. They show a mechanism so perfectly designed that it makes 1870s Monopoly look like a child's game. And the terrifying part isn't that it exists. It's that everyone knows about it and no one can stop it. Start in 1998. The technology was primitive. You couldn't buy a stock with a phone call anymore. You had to use a broker. That broker had a choice. Send your order to the New York Stock Exchange, where a specialist would execute it, or send it somewhere else, somewhere cheaper, faster, more profitable. Bernard Madoff, yes, that Bernard Madoff, before he became a household name for fraud, ran an operation called Bernard L. Madoff Investment Securities. He offered brokers something irresistible. He would execute their customer orders at better prices than the exchange. How? He didn't actually execute them. He bought the stocks himself first, at the exchange price, then sold them to the broker's customers at a slightly better price. He profited from the spread. The brokers profited from the spread. The customers thought they got a good deal. The exchange? Furious, but powerless. Madoff was legal. This was the blueprint. Payment for order flow wasn't invented in 1998. It was legalized. The Securities and Exchange Commission had been watching. In 1997, they issued Rule 10b-1. It said market makers could pay brokers for their order flow. It was supposed to be transparent. It was supposed to create competition. What it actually created was geometry, a mathematical trap. Here's how it works. You decide to buy 100 shares of Apple at the market price. Your broker is Fidelity or Robinhood or Schwab. That broker receives your order. Instead of sending it to the public exchange, they send it to a market maker. Citadel Securities is the largest. In 2024, they executed roughly 25% of all U.S. stock trades, 1/4 of every purchase you make in America. That market maker already owns Apple shares. They sell you their shares at a price that looks slightly better than the exchange price. You feel like you won. You saved 0.03 cents per share. Citadel collected 0.02 cents per share. Your broker got paid for that order. Citadel made their money. Everyone won, except you. Here's what the ledgers actually show. Citadel profits from knowing what you're going to buy before the market knows. When your order comes in to sell Apple, they hold shares. They execute your sale slightly faster than the exchange could. You feel efficient. But Citadel has already purchased Apple shares on the public exchange at a price they knew they could sell to you at a profit. They're not winning because they're smarter than you. They're winning because they see your trade 3 seconds before everyone else. In high-frequency trading, 3 seconds is an eternity. 3 seconds is enough to buy before you do and sell after you do. The parallels are exact. In 1870, Rockefeller did something similar. The Standard Oil Trust didn't refine more oil than competitors. They didn't have better technology. They had information. When a competitor ordered barrels of crude, Rockefeller saw the order. He could then adjust his prices, position his refineries, and undercut that competitor because he knew what was coming. The Pennsylvania Railroad gave him the intelligence because Standard Oil shipped more oil than anyone else, so they gave him preferential pricing information. Rockefeller didn't steal the information. He was paid for taking it. The railroad got more business. Rockefeller got advance notice. Competitors got destroyed. The mechanism hasn't changed. The geometry is identical. In Rockefeller's case, order, information, position, profit. Today, your trade, Citadel sees it. Citadel positions, Citadel profits. 1 century later, same playbook, different technology. The scale reveals the extraction. In 2023, payment for order flow totaled approximately $2.3 billion. Brokers receive payment from market makers for sending them order flow. Robinhood's primary revenue stream isn't brokerage fees, it's payment for order flow. In 2022, 75% of Robinhood's revenue came from payment for order flow. You get a free trading platform, but free means you're the product. Your order data is the commodity. Citadel is the buyer. The SEC has tried to regulate this 4 times since 1997. Every attempt failed. Every regulation was designed to require transparency. Every transparency rule assumed that if people knew about the conflict of interest, they would stop participating. But the archives show this doesn't happen. What happens is everyone knows. No one leaves. the system becomes accepted. In 2021, the GameStop saga revealed the mechanism to everyone at once. Retail traders discovered that short sellers and market makers were coordinating through payment for order flow. Citadel, which invests in Melvin Capital, a major short seller, had visibility into retail buy orders. They could position accordingly. The DTCC halted trading on GameStop, not because of a technical issue, but because the arrangement became transparent. Now, the moment people started asking questions about payment for order flow, the arrangement tightened, but it didn't disappear. It just became less visible again. The evidence is documented. Citadel's own filing from 2023 states they execute 48% of all U.S. equities order flow. That number grew from 22% in 2015, 8 years. The market share doubled, not through innovation, through capture. They became the preferred order flow destination because they could pay higher fees than competitors. Where did that money come from? From the profits they generated by seeing orders before the market. Circular extraction. Here's the terrifying efficiency. The entire system is legal. The SEC permits it. Congress has never banned it despite multiple attempts by individual representatives. The exchanges compete for payment for order flow revenue. The NASDAQ receives hundreds of millions annually from market makers, paying to locate orders there. The NYSE does the same. The infrastructure itself profits from the arrangement. Every party, except the retail trader, profits from the order flow knowledge asymmetry. Compare this to 1911 when Standard Oil was broken apart. The government recognized that seeing competitors' moves before they happened constituted monopoly power. The federal government forced the breakup into 34 separate companies. The Supreme Court ruled that the vertical integration, while technically legal, had created such an insurmountable information advantage that it was effectively anti-competitive. Today, Citadel holds roughly 25% of all equity trades. Standard Oil at its peak held approximately 85% of oil refining capacity. But remember, Rockefeller's monopoly was visible. You could see the oil, you could see the refineries. Market share was obvious. Information monopolies are invisible. Payment for order flow is a data monopoly. You cannot see it unless you're looking at microsecond timestamps. The structure is identical. The visibility is not. The system requires participants to accept a foundational lie that everyone has access to the same information simultaneously. But they don't. You see your executed price. You see the market price at that moment. What you don't see is that Citadel saw your order 300 microseconds before the public market knew it existed. That microsecond is everything. In 1 microsecond, a high-frequency algorithm can buy shares on the public exchange and sell them to you in a private transaction. You saved 0.03 cents. They made 0.02 cents. The exchange never saw your trade. The market price never adjusted for your presence. You've been made visible to one entity while remaining invisible to the market. This is the modern mirror of Standard Oil. One entity with complete information visibility. Everyone else operating in the dark. The architects who built this system knew exactly what they were doing. In the 1990s, when technology allowed for market fragmentation, the assumption was that competition would solve the information asymmetry. Multiple exchanges, multiple market makers. Transparency would emerge. What actually happened was consolidation. The number of independent market makers declined while their market share increased. By 2024, the top 5 market makers control 75% of equity order flow. Citadel controls 25% alone. The second largest, Virtue Financial, controls roughly 20%. Together, they control nearly half of all U.S. stock trades. The system designed to create competition created a duopoly with perfect information visibility. Every time you place a trade, you're engaging with this mechanism. You buy Apple. Citadel sees it. They already own Apple. They sell it to you at a price so close to fair market value that you cannot detect the extraction. You feel like you got a good deal. You did, marginally. But Citadel profited too. And they profited because they saw you coming. That is the definition of the mechanism, not theft. Design. The records show this happens approximately 2 billion times per day. 2 billion orders flowing through market makers who profit from seeing the order before it hits the public market. The 3 paths forward are worth examining. First, accept and use it. The system delivers efficiency. You can trade stock instantly for free. In 1870, trading a stock took days and cost commissions. Today, it takes seconds and costs nothing. The convenience is real. The price you pay for that convenience is accurate price discovery. When market makers profit from information asymmetry, the public price of stocks reflects that asymmetry. But you benefit from the speed. You benefit from the liquidity. That benefit is real. Citadel gets richer. You get speed. Both are true. Second, resist it. Use an exchange that doesn't use payment for order flow. Those exchanges exist. They're smaller. They're slower. They're more expensive. You'll pay commissions. You'll wait longer for execution. But your order won't be visible to market makers before it hits the public market. Your trade will be anonymous until it's executed. The cost is real, but your information stays private. Third, position within it. Understand that you're not trading in a free market. You're trading in a curated market where certain entities have information advantages. Trade accordingly. Don't try to outrun Citadel's algorithms on a 3-second timescale. The pattern they're using is decades old. It's not going to disappear. Build a strategy that acknowledges the information asymmetry rather than fighting it. This is pattern recognition, not advice. The deeper protection lies in understanding what survives every collapse of trading systems throughout history. The ability to execute a real transaction. The skill of knowing what something is actually worth independent of what the market says it's worth. In 1637, during the Dutch tulip bulb crash, the traders who survived weren't the fastest. They were the ones who could grow tulips. In 1929, before the crash, the traders who preserved wealth understood what companies actually earned. They could evaluate the substance beneath the price. In 2008, when the financial system collapsed, the traders who survived were the ones who understood what mortgages were actually worth. The speed traders, the information traders, the margin traders, they all vaporized. The people who understood the underlying asset survived. The archives call this production over paper promises. You can lose to Citadel in the market, but if you understand what you're buying, if you understand Apple or Microsoft or Nvidia's actual capacity to earn money, you can survive the information asymmetry. Not beat it, survive it. The market maker can profit from 0.02 cents on your transaction. But if you hold for 5 years and the company doubles, your 0.02 cent loss becomes irrelevant noise. The extraction only works on the fraction. Production survives the system. Spain dominated markets for 200 years through information monopoly. They controlled sea routes. They saw shipments others didn't. They positioned accordingly. But they didn't build factories. They didn't innovate. The routes dried up. The information monopoly died. Britain built factories. They built production. They kept the power longer, not forever, but longer. The principle is documented across every archive. Paper money collapses. Information advantages evaporate. Production persists. We are at stage 5 of this pattern. Stage 1 was legalization of market fragmentation in 1997. Stage 2 was the emergence of payment for order flow as a standard practice in the 2000s. Stage 3 was consolidation. The number of market makers declined while their market share increased. That happened in the 2010s. Stage 4 was the revelation. GameStop exposed the mechanism to the public in 2021. Stage 5, where we are now, is normalization. Everyone knows about payment for order flow. Nothing changed. Trading continues. The system is accepted. History says what comes next. Stage 6 is concentration. The market share of the top players consolidates further. It already has. Stage 7 is systemic crisis. Something breaks. A flash crash. A major player fails. Something that reveals the information asymmetry wasn't just elegant, it was fragile. And when that happens, when the system breaks, the politicians will rush to ban payment for order flow, just as they banned the practices that caused the 2008 crash. The ban will come late, after the extraction is complete, after the wealth has been transferred, just like 1929, just like 2008, just like every collapse the archives show. The thing they built, payment for order flow, wasn't designed to be fixed. It was designed to be invisible. It wasn't designed to be escaped. It was designed to feel inevitable. A market maker with information visibility looked like a natural feature of efficient markets. It's not. It's a trap designed 25 years ago by people who understood that you cannot regulate something you cannot see. Citadel doesn't break any rules. They follow the rules perfectly. But the rules were written in 1997 by people who couldn't imagine microsecond visibility into billions of daily orders. Now that technology exists, the rules have become invisible extraction. The pattern says you will keep trading. The market makers will keep seeing your orders first. The profitability will concentrate further. The regulation will come too late. And by the time it does, the wealth transfer will be complete. The archives have already written this script. We're just watching it play out. Every order you place in the stock market passes through Citadel. They profit from knowing you placed it before the rest of the market knows. They profit from your visibility to them and their invisibility to you. This isn't an accident. It's not innovation. It's geometry. The same geometry that made Rockefeller unstoppable. The same geometry that concentration always creates. The archives are clear on what happens next. The question is whether you'll see the pattern before you live the collapse. If this pattern revealed something you'd never seen before, subscribe to the Gilded Archives. History's ledgers are specific. We just show you which page you're on. The records are waiting. Your position in the pattern is documented. The outcome is archived.